Welcome back to the week that was. And if you're listening to this, I think congratulations are in order. You actually survived one of the most chaotic weeks in financial history.
I mean, seriously.
I feel like we lived through a decade of market moves in about 4 days. It was. It was something else.
It really was a stress test for every single narrative we have in this space. We saw Bitcoin act less like a currency and more like a high-speed liquidity gauge for the entire global economy.
It was total whiplash. We went from a nice, stable floor, crashed all the way down to $60,000, which, felt like the end of the world for a minute there.
It did.
And then snapped right back to $70,000 in 48 hours. So the mission for today is pretty simple. We need to unpack exactly what just happened, why the crash, why the bounce, and I guess, why does it feel like the rules of the game just changed?
Precisely. And to do that, we have to look past the price chart. We need to look at the structural shifts happening underneath. It wasn't just volatility. We saw miners effectively exiting the crypto business to become AI infrastructure companies.
Right.
We saw stablecoins morphing into what looked like sovereign-grade debt instruments.
Yeah.
And we saw a geopolitical flare-up that completely separated Bitcoin from gold.
And we have to talk about this concept of a liquidity shock. I mean, it is wild to me to think that a tech CEO making a comment in Korea is what crashed crypto wallets here in the U.S.
That is exactly where we need to start.
Yeah.
Because if you don't understand the liquidity plumbing, the price action makes zero sense.
Okay, let's get into it. Start of the week, Bitcoin breaks its structural floor of $75,000. Everyone is panicking, Twitter's on fire, people are thinking crypto is dead again. But looking at the data, was this actually a crypto problem?
No, and that's what makes this so fascinating. This was an imported crisis. It started in Seoul, not New York. To understand why your portfolio bled out on Monday, you have to look at the Korea exchange. I mean, things got so bad so quickly that they actually triggered a sidecar trading halt on the KOSPI index.
Whoa, hang on, a sidecar halt. I'm picturing a motorcycle, but I assume that's not what we're talking about. What does that actually mean for a stock market?
Yeah, no. Think of a sidecar halt like a referee blowing the whistle in a sports game because things are getting too rough.
The computers at the Korea exchange realized that sell orders were piling up way faster than buy orders could match them.
So they just pulled the plug.
The program literally pulls the plug on program trading for 5 minutes just to let cooler heads prevail. It's a circuit breaker. But here's the thing. In crypto, there is no referee. There is no whistle.
Right. Crypto never sleeps. So what triggered this panic in Korea in the first place?
It was the AI trade bubble popping. NVIDIA CEO Jensen Huang came out and clarified that a rumored investment in OpenAI wasn't a commitment. It was just a possibility.
That seems minor. Just a clarification. In a rational market, yes. But this market was frothy. That little bit of nuance just shattered the speculative bubble.
Yeah.
Samsung Electronics fell over 6%. SK Hynix dropped nearly 9%. I mean, these are the titans of the Korean economy.
Okay, I get that tech stocks took a hit, but connect the dots for me. How does Samsung falling 6% cause Bitcoin to nosedive?
It's the mechanism of leverage. You have to put yourself in the shoes of a South Korean retail trader. It's 3:00 a.m. You are highly leveraged in tech stocks.
Right.
Suddenly, Samsung crashes. Your broker isn't asking politely for more money. They're issuing an immediate margin call. You need cash right now to save your stock portfolio.
But the banks are closed.
Exactly. The banks are closed. The stock market is halted. What is the only asset in your portfolio that trades 24/7 and has deep liquidity?
Bitcoin.
You sell your Bitcoin. Not because you lost faith in it, not because you think the blockchain is broken. You sell it because it's the only thing you can sell. Bitcoin acted as a globally accessible ATM.
So it's a correlation shift. Bitcoin became a liquidity source for the equity market.
Correct. And that selling pressure traveled globally. It crushed the kimchi premium, which is the extra price Koreans usually pay for Bitcoin. And then the arbitrage bots just dragged the global price down to match it.
That makes so much sense. It's not about the asset, it's about the need for cash. And that leads us to the corporate fallout. We have to talk about Strategy Inc., formerly MicroStrategy.
Oh, yeah.
I saw some headlines that for the first time in this cycle, they were actually underwater on their massive position.
They were, and the timing was just absolutely brutal. Just days before this crash, they filed an 8K confirming they had bought another batch of Bitcoin, about 855 coins.
Wow.
At an average price of nearly $88,000.
Ouch. They bought the absolute top.
They bought the local top, yes. And when the price dipped to $60,000, Their entire aggregate position of over 700,000 Bitcoin was in the red. We're talking about billions in paper losses.
Yeah.
It created this soft ceiling of resistance because the market knows they are under immense pressure.
I actually saw a tweet from their chairman right when things were looking grim. It was just 2 words, more orange. Usually that feels like a victory lap, like, look at us winning. But given the context, was that him trying to rally the troops?
In this context, it was purely defensive. Think about it. Shareholders are facing dilution, the stock price is plummeting, and your main asset is underwater. That tweet was a signal to the market and its investors. We are not selling. We are not changing strategy. It was reassurance, not celebration.
Okay, so we have an Asian liquidity crisis starting the fire. MicroStrategy is underwater. But then, just as things look like they might stabilize midweek, I think there was even talk of some massive U.S.-India trade deal, we got hit with a geopolitical shock.
And this is where the narrative gets really complicated. Because we had a classic flight to safety event, but it failed completely for Bitcoin.
Set the scene for us. What actually went down?
The U.S. F-35C shot down an Iranian drone near the USS Abraham Lincoln in the Arabian Sea.
Okay, that is serious. That's direct military engagement.
It is. And the market reacted instantly. It was a classic panic. Now, for the last 10 years, what is the story we've been told about Bitcoin?
It's digital gold. If the world gets scary, if there's war or inflation, you buy Bitcoin to be safe.
That's the sales pitch. But the data said otherwise. When that news hit, gold and silver rallied hard. Gold reclaimed $4,930. It did exactly what a safe haven should do.
And Bitcoin?
It dumped alongside the Nasdaq.
That is a harsh reality check. It decoupled from gold completely.
It did. The market treated Bitcoin like a risky tech stock, a risk-on asset, while gold behaved like the safety bunker. We saw massive outflows from the U.S. spot ETFs. Nearly $1 billion left the system in 48 hours.
Man, that had to hurt the true believers. You wait for your moment to shine as a hedge against chaos, and instead you trade like a tech stock. But not everyone was selling, right? I heard there was some interesting divergence in who was leaving and who was staying.
That's the key aha moment here. While retail traders and smaller funds were panic selling, fleeing for the exits, BlackRock's IBIT ETF stood alone.
Really?
Eventually, they started seeing inflows while everyone else was bleeding.
So weekend selling to the world's largest asset manager.
Exactly. It signals a transfer of coins from nervous speculators to long-term strategic holders. BlackRock absorbed the liquidity that the panic sellers provided. They aren't worried about the day-to-day volatility. They're looking at the next decade.
Now, I want to pivot to the build layer, or the infrastructure side of things, because while we were all staring at the price crashing, the companies that actually mine Bitcoin were making some drastic changes just to survive.
We call this minor capitulation. And to understand it, you just have to look at the math of their business. It's a simple spreadsheet problem. The price of Bitcoin hit $60,000.
Right.
But for many of these industrial miners, the production cost, electricity, hardware, cooling to mine 1 Bitcoin is sitting around $87,000.
Wait, let me get that straight. They are spending $87,000 to create something they can only sell for $60,000.
That is correct.
That is a terrible business model. You're literally burning cash every time you turn the machine on.
It's completely unsustainable. The hash price, which measures how much revenue a miner makes per unit of computing power, hit an all-time low of 3 cents. The economics just broke.
So what do? Do they just shut down and go home?
Some do, but the big players are pivoting. We are seeing a great AI pivot. Look at CleanSpark. They reported a massive net loss due to Bitcoin devaluation, but in the same breath, they announced a shift to high-performance computing.
Which is just a fancy word for AI infrastructure, right?
Oh. Yes. They are taking their massive power connections, which are incredibly valuable right now, and instead of running hashing algorithms for Bitcoin, they are preparing to rent that power to AI companies.
We have the power cables, you have the chatbots, let's make a deal.
Exactly, and then you have bit farms. They took it to an extreme that I frankly didn't expect.
What did they do?
They effectively committed corporate suicide of their crypto brand. They are rebranding the entire company to Keel Infrastructure and moving their domicile to Delaware.
Keel Infrastructure? That sounds like a utility company from the 1950s. It doesn't sound crypto at all.
That's the point. They want to trade on data center valuations, which are skyrocketing because of the AI boom, instead of being tethered to Bitcoin's volatility. They're becoming energy arbitrage firms.
Smart.
If mining Bitcoin doesn't pay, They rent their power cables to the AI sector.
It's smart, honestly. But it really shows how desperate the mining landscape has become. Now, if miners are the losers of the week, the winners seem to be the stablecoins.
The contrast is just stark. While miners are rebranding to survive, Tether reported a $10 billion profit for 2025.
$10 billion. That is massive. And they aren't just sitting on cash, right? They are making some very strategic moves into the regulated world.
They are building a fortress. Tether bought a stake in Anchorage Digital.
And that's a federally chartered crypto bank.
Exactly. That's a big deal because banking access has always been the choke point for crypto. If you can't get a bank account, you're dead in the water.
It bypasses the blockades.
It does. And they didn't stop there. They invested heavily in gold.com. The strategy is to integrate physical gold with their stablecoins.
So they are using their fiat profits to buy hard assets, gold, and U.S. banking access.
They are acting like a sovereign wealth fund. And this aligns perfectly with what we are hearing from Washington. Treasury Secretary Scott Bessent laid out a no bailout doctrine this week.
Meaning the government isn't going to save Bitcoin prices if they crash.
Right. There's no Fed put for Bitcoin. But Bessent made it very clear they view stablecoins as essential tools. Because stablecoin issuers are massive buyers of U.S. Treasury bills. They are helping fund the U.S. debt.
So Bitcoin is on its own, but stablecoins get a seat at the table because they buy government debt. That brings us to the political drama of the week, World Liberty Financial.
This is a messy situation. World Liberty Financial, or WLF, is under a congressional probe led by Ro Khanna. They're looking into a $500 million investment from the UAE and potential diversion of microchips to China.
Whoa, okay. Microchips to China, that is national security level stuff. You'd think with accusations like that, the market would panic and dump their token.
You would think. Logic dictates the price should collapse. But the market reality was the opposite. Despite the probe, their stablecoin, USD1, saw its market cap soar to $5.2 billion.
Why? That seems totally counterintuitive. Are investors just ignoring the news?
It's largely driven by usage on Binance, but there's a deeper psychology here. It suggests the market believes the project is too big to jail because of its political connections. Investors are betting on protection rather than fearing regulation.
It's a bold bet. Okay, let's move to the end of the week. We had the crash, the panic, the miners quitting, the stablecoins booming, and then the bounce. We saw a V-shaped recovery taking us from 60,000 back up to the 70,000 range. How did that happen so fast?
It was a mechanical recovery. First, you had the flush. About $2.6 billion in leverage was wiped out during the crash.
Wow.
That reset the market. The sellers simply ran out of ammo.
And then the buyers stepped in.
But not just any buyers. It was a short squeeze. Traders who were betting on a further drop to 50,000 got trapped, and who stepped in to trap them?
Let me guess. BlackRock.
BlackRock. They came in with over $230 million in buy orders on Friday.
So BlackRock effectively set the floor.
They did. When the price didn't break down further, the shorts had to cover, which drives the price up, which forces more shorts to cover. That's a classic squeeze.
But here's where it gets really interesting to me. While the price recovered, the macro situation actually got worse. We saw the return of economic warfare.
We did. And this is the part that people aren't paying enough attention to. President Trump signed Executive Order 13330. This authorizes 25% secondary tariffs on anyone trading with Iran.
Okay, unpack secondary tariffs for me. How is that different from a normal tariff?
A normal tariff is tax goods coming from your country. A secondary tariff is much more aggressive. It's the U.S. telling a country like India, if you trade with Iran, we will tax you.
Wow.
It forces neutral countries to choose sides.
That sounds incredibly disruptive. It targets major economies like India and China directly.
It creates a bifurcated world. It potentially nullifies those trade deals that were discussed earlier in the week. It's a scorched earth policy following the collapse of talks in Muscat.
Usually chaos like that, trade wars, tariffs, that strengthens the U.S. dollar, right?
Right.
When the world gets messy, everyone wants dollars. And a strong dollar usually pushes Bitcoin down.
That is the textbook correlation. But right now, Bitcoin is ignoring that macro threat. It's favoring the flow dynamics, the ETF buying, and the short squeeze over the geopolitical reality.
It feels like a disconnect.
It is a massive disconnect. The market is looking at the liquidity flows and saying we're back, while the geopolitical landscape is saying brace for impact.
So, to summarize the week, We imported a liquidity shock from Asia that crashed the price. We saw miners pivoting to AI because their business model broke. We saw stablecoins acting like sovereign funds. And we ended with a price recovery that is completely ignoring a looming trade war.
That's the week that was.
It feels like we were walking a tightrope.
I think the most important thing for you to take away from this is that divergence. The market is cheering the price recovery back to 70,000. But look at the infrastructure layer. The miners are flashing red warning signs.
Right.
Look at the geopolitical layer. Tariffs and military tension are flashing red.
The price is signaling all clear, but the engine room is signaling danger.
Exactly. The question you have to ask yourself this weekend is, how long can financial flows ignore the physical reality? Can BlackRock's buying power outweigh a global trade war and a minor capitulation?
That is the question to mull over. In this market, patience and looking under the hood is the only edge you have. Thanks for tuning in to The Week That Was. We'll see you next time.